Good evening, all. It is Sunday night. Hope you had a great weekend. This is Shay Horowitz, ShogunTrading.com. Sorry about the break from the weekly newsletter. We've been extremely busy. My wife and I are expecting our first child, so this is a very exciting time for us. Very busy time for us, and so on. Anyway, the market has been unique to say the least. This is the most different, weird market I've ever seen, and I've been in the market for a very long time. We're basically we lost our momentum. We lost the fuel behind the market. The market has been in a very choppy sideways market back and forth. Yes, we gone up. We had the bottom at the 666, and then we climbed up, and then we pulled back, climbed up, pulled back, climbed up, pulled back, and this is basically where we're going. This is abnormal for the market. The market usually goes into a trend, but a trend takes decisiveness. It takes decisions. It takes one side, the bullish side or the bearish side taking over. So if the bulls are running the table, they'll take off and we'll have a nice trend. If the bears are running the table, we'll have a nice trend as well. But somewhere in between, where neither the bulls, because they can't really see a reason to run the market up, or the bears, because they don't want to go short on the market, if neither one of them takes possession of the market, if neither one takes the lead, the market will go sideways. And for us, that's it's no fun. But it does happen every once in a while. I do want to introduce you or show you an indicator. Some of you have seen this one before, I'm sure. This is the DMI. It's basically a trend indicator. And here's what I want to show you. The yellow line is separate from the red and the blue. The yellow line goes up and comes down. Yellow line is a measurement of the trendiness of the market. It's completely independent of direction. It doesn't show whether the market goes up or goes down, but it just shows you the strength of the trend. And you can see how we had a very nice trend over here. That was the downtrend over here. We made a ton of money over here, and then the market turned around, and then it started drifting up. And yes, everybody's celebrating it. The market's going up, the market's going up. But look at the trend indicator. That's just absolutely coming down and coming down and coming down. This is basically just shows that the trendiness of the market is not really very high. The blue line is basically showing the strength of the uptrend. The red line is the strength of the downtrend. You can see that they're pretty close to zero, versus over here where you see them all the way up and down. Whenever the separation between them is great, that's usually when you get the really nice big trends, big moves in the market on a daily basis, and it's really a good time. But every once in a while they get pretty close to one another, and they stay there for a little while. But usually what happens when they stay around for a little while, the yellow line will dip and will make a bottom, and after that it will shoot straight up. You see how it shoots straight up? That corresponds to big trend that followed, and over here also a big trend that followed. Excuse me. This is big money maker. This was a tremendous money maker. This was a tremendous money maker. That's the periods that you're looking for. And these periods always follow lows on this indicator. Now, I don't use this indicator to really predict the market because it's almost always late, so I don't use it for entry, but I do use it to measure the condition of the market, of what it does. It's one of the many tools we use, of course, but this one is really good for illustration purposes. But what I want to show you, and this is where I'm going to really zoom in right now, is I want to show you how we had a very nice trend, and then we came down and 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 down. That's abnormal. But what follows is what's really interesting to me. Now, this is something that we're starting to notice in our trades, the trendiness of the market. I'll give you an example. PQ, just an energy company that we picked right at the 317, went all up to 380 in just a day, which to me is that's what I look for. Or OSG, for example, that also 27.32 all the way up to the 398, almost a $34 level. That's what we're looking for. Rambus was also very nice for us, from 10.52 all the way up to the 12.50 level. These kind of 20% return trades is what you're looking for, because if you can catch a few 20% trades per month, that makes your month. You can catch a lot of break evens, a lot of small stops or whatever, but if you catch a couple of very nice 20% trades, you can have that 10% return per month. You can have that 5% return on your account per month. That 20% return on your account per month, which are returns that we can't get anywhere else. Now, the market can go into drifts up, can go into drifts down, can go into monster trends up and monster trends down. You do not want your equity line to do the same thing. You want your equity line, your account, to go up on a steady basis on every month. Even if you only get 5% per month on a monthly basis, you're doing very well because it accumulates to quite a bit on a yearly basis. Our goal is the 20% trades that allow us to show those kind of returns. So, yes, it was rough. It's been a rough month because the market itself, and here's a picture of the S&P 500 over the past month. You can see that, here's April. And you can see that basically during April, this is about the beginning of the month, you can see that we didn't really go a whole lot. The market really didn't move a whole lot. Yeah, we drifted up, and the media has been, absolutely going bananas over it. But the trades are working, and that's what I'm excited about. Those 20% trades, and like I said, you only need a few of them per month to really make a difference in your portfolio. Now, what's going on with the market right now? We have a stress test that on the banks. The banks had a monster quarter. They had a record quarter in the first quarter of the year, and record earnings and so on. And then the stress test, we learned that some of these banks actually need a $10 billion enhancement from the government. We have General Motors and Chrysler going into bankruptcy. We have auto sales at a low. We have GDP decreasing by 6%. We have record unemployment and so on. Not very good news. But the market always trades 6 to 9 months ahead. What's going to happen 6 months from now? What's going to happen 9 months from now? Investors look at that and they say, you know what, I'm going to invest my money right now. And that's why we're seeing a little bit of a drip into the market. We're seeing a little bit of accumulation, a little bit of people buying into the market. It's not monster, but people are starting to say, well, is it going to change 6 months from now? We don't like the economic picture. The economic picture does not look good. But is it going to change? Is it going to improve itself? Is this the bottom? That's what people are jumping on. But people are still extremely cautious, and that's why you're seeing that the market is going sideways. Neither the bulls nor the bears are actually taking charge over here. The bulls are accumulating just a little bit of time, not taking too much of a commitment. If the market pulls back even just a little bit, they come out a little bit. And the short sellers don't want to go short against our new administration. And the reason why is because they get hammered every time they go short. So the short sellers are basically stepping aside. They say, you know what, we're not going to short the market until we know what the rules are. We know what how the administration is going to treat Wall Street. And that's when they're going to step back in. Now, what I'm looking at is which trend is going to happen next. I'll go back to my trusty moving averages, and I'll go back to the daily chart on the S&P 500, and you can see that, yeah, we're drifting up right now. That's the trend. We are drifting up, but there's still so much overhead supply. Overhead supply means that most people own stocks at much, much higher levels. If most people own stocks at much, much higher level, if the market pops up just a little bit, they have a profit in it, and they will sell. They don't have a profit if they they don't have a profit. They actually have a major loss in it. I take that back. I don't know what I was thinking. But they have a major loss in it. And if the market pops up a little bit, they'll say, oh, thank goodness, and they'll sell. Because they didn't get to sell at the bottom, and people feel a lot better if they don't sell at the bottom, if they sell a little bit higher from the bottom, and they'll be much, much happier. So if the market shows any kind of weakness right now, we can have tremendous amount of sellers coming in, we can have a tremendous amount of short sellers coming in as well. If the market shows more signs of life, we might actually have more investors with money sitting on the sidelines coming in and boosting up the market to the long side. Anyway, I'm running out of time in this week's newsletter. Again, sorry about taking a couple weeks off. Been extremely busy. Have a great week. Find those 20% gainers. That's where the money's at. You want to do it on a consistent basis. Have a great week, and I'll talk to you tomorrow. Those that are on our nightly newsletter, I'll talk to you tomorrow night. Take care.